time for stock picks. Today we are looking into big names with global reach. We have entertainment giant Disney, athletic powerhouse Nike, and biotechnology company Amgen Inc. And joining us in studio to analyze these stocks is Jordan Toy from Legacy Family Wealth. Jordan, thanks so much for your time this afternoon. And it's interesting to see that you've just picked American stocks, even though we are seeing a bit of a rotation out of the US to Europe, to Asia, as well as the JSE. Is it on the back of these lower prices that we are now starting to see more opportunity sparking?
So I think from our perspective, there's a number of factors that play into this, right? So the one being that we don't think necessarily that US exceptionalism is over, right?
Okay.
These are still some of the biggest businesses globally, some of the most innovative businesses. Yes, there are challenges, there's regulatory shifts, the landscape may shift in the longer term, and we keep an eye on those things. But for certain companies, there just isn't alternatives. There aren't replacements for, arguably the likes of a Netflix overseas. There are alternatives, but are they, are you taking the third or second or fourth choice in that category? So I think from that perspective, we still like the US. And as you mentioned, certain of these stocks look a little bit more attractive now from a price perspective. There's always risks, right? Stocks are generally low for a reason, so something we have to be conscious of. But yes, we certainly still like the US market in the long term.
All right, let's get into it. Disney, one of your picks, and they seem to be recovering well. That streaming business also gaining traction. Theme parks also doing fairly well. Talk me through why this is one of your picks.
So I think we like it from a sort of diversification and correlation perspective. Yes, it is still a US equity and will still largely move in line with US equities. But when you look at it, it's not a pure play in any one area, right? So Netflix, you've got streaming. Disney is growing their streaming base, and we keep a close eye on that because I think the future of sort of entertainment in the US has been changing quite rapidly over the last couple of years, right? We've seen the rise of streaming. How successfully does Disney continue to adapt with that, and consequently, what is the growth in their subscriber base in streaming? I think one other point to just mention on the streaming aspect for Disney is that we've seen Netflix move away from just talking about subscriber growth, right? It's now about what is the monetization of those subscribers? Do we have sort of ad-supported tiers that are bringing in revenue as well as a mixture of premium packages? So I think less focus on the subscriber numbers. They obviously are still important, right? So we're seeing that side of the business grow. We're seeing, Disney's sort of partner in some ways, and we'd like to see more on the ESPN front. Can you bring sport into streaming? We know Netflix is trying to do that as well. So that's sort of the one compartment of the business that we quite like and we keep a close eye on, and I think one that's going to drive it going forward. Then you've got the sort of theme park aspect, which is obviously a very different business to the likes of the streaming. And from that perspective, that's why I say we like it in that it plays in a few different areas. I suppose from a valuation perspective, it's sort of less beaten up than, we're going to talk about Nike in a little while. So, and I suppose that more broadly links into the question of sort of what do we deem as an undervalued stock? Because, you might have very different expectations to me of what the growth looks like going forward. So I think that's just one point to bear in mind. So from our perspective, sort of on a PE is an oversimplified ratio, but from a forward price earnings perspective, we view Disney as being quite significantly below the S&P 500 or the S&P 500's broader average. So that gives us a degree of comfort or confidence that we are potentially entering this at a slightly more attractive point. And it's a big mature business. We're not expecting very rapid growth in a short space of time with Disney. We're expecting that sort of dependable earnings growth and dividends growth over time.
And I want to just go back to the streaming side of the business and how it fares against its competitors like your Netflix and as well as Amazon Prime, especially when it comes to innovation, because it does seem like, the older legacy companies take a longer time to innovate.
Yes, certainly, and we've seen a bit of instability in terms of the governance and leadership of Disney as well. We saw Bob Iger having to come back, trying to now change the business around. We've also got to look at, and he is already looking at, and the board as well, who's the next successor to take over, because he's come back to try and sort of stabilize that entity. But you talk about sort of the innovation, and I think that's something that Disney more broadly has got to watch quite closely, right? Yeah. So Netflix has obviously got a lot of their own content that they're generating and a significant volume of that. Disney, we've got two aspects to it, right? We have what do they have on the streaming platform, but also from sort of the Pixar and the animation side of things. And there we are keeping quite a close eye because it's a case of, recycling old content because, like we talk about their latest movie being Stitch, right? That was a movie that was originally brought out sort of, probably a decade or two
Years
ago. So
ago.
arguably the younger audience now hasn't seen a lot of this content. So we'd like to see a bit of a blend, right?
It also unlocks that nostalgia from the older audience as well.
Exactly. So people who watched Stitch as kids are now going there with their children. So I don't think it's a case of, oh, well, it's just the old content being recycled. Yes, that does have sort of some degree of diminishing marginal returns. There needs to be a mixture of also new content coming to the fore. And we're comfortable that Disney has they've been beaten up a bit in that respect. Some of the box office results have not been the greatest over the recent past.
Yeah.
But you look across the board at their metrics, they're coming off a relatively low base, so we do think that there's opportunity for them to improve and sort of regain some of that lost prominence.
All right, let's move over to Nike. The company really went through it under John Donahoe, where we saw Nike turn to direct selling, with some analysts saying that was its actual downfall. Years later, we are seeing, the group back with Amazon even trying to expand its reach as well. Are you thinking, or are you seeing Elliott Hill just turning things around there?
Well, I'm glad that you used the term turnaround, and I think that's very much what this is, right? It's a turnaround story, and it sounds weird to say for a company of Nike's stature, but I think it definitely is. If you look at it across the board, whatever metric you want to look at, there has been sort of a deterioration, and it's exactly that. Can the new CEO, Elliott Hill, turn it around? We talk about some of their potential missteps. So the direct-to-consumer model, has that really worked? Arguably not. I mean, we know that sort of Foot Locker was a big source of revenue for them, and almost a bit of a backtracking now. Now we're seeing Nike start listing products on Amazon again. So the thing that I think it's easy to forget when looking at the shorter term numbers, this is a very dominant brand. In terms of brand awareness, it ranks consistently sort of in the top 20 globally. I believe I was looking at I can't remember the exact survey, but sort of top 3 brands in Africa. It's a brand that has a massive moat around it.
Yeah.
Right? It's got a huge amount, just that the logo alone has huge value to it. So can you get back to basics and actually start delivering sort of the products that meet sort of the level that the brand is at, and start reducing some of the inventory? So I think they talk about shoes, for example, right? Nike Dunks are a specific shoe that they release, and one that they have said has maybe been overproduced, right? So there needs to be a bit of rebalancing going on there. But from a share price perspective, I mean, on a 5-year basis, on a 1-year basis, it's obviously been punished by the market. But if you look at it from a price earnings perspective, it's largely still in a very similar place to where it was, because we've seen earnings fall off. So like I said, to get back to my initial point, it's a turnaround story. Can the new CEO sort of fix some of the areas that are going wrong, which I don't think are insurmountable challenges, and sort of return that business and start turning those metrics around and return to sort of profitability?
And it's interesting, that you mentioned that the brand is really big, and you'd never think that a company like Nike is in the process of a turnaround story. I mean, you walk around the streets here in Johannesburg, and you'll probably spot 2-3 people wearing Nike sneakers, right? And I want to talk to you about sales then, and especially when it comes to those price pressures as well as competitors. Looking at Adidas, they've also faced quite a lot of troubles, even in the past few years, with the whole thing around Kanye West. So how does it compare with its competitors at the moment? And do you think they have enough power when it comes to prices, also considering that we do have those tariffs also coming through?
So I'm glad you mentioned the tariffs. Obviously a very big risk to a company like Nike, right? The US, wherever tariffs settle, I don't think the US is ever going to be in the business of manufacturing shoes domestically, or at least not in a cost-effective manner. So that's a big risk. But I think it is a risk largely that applies to a number of the competitors, being the Adidas. There are newer competitors that we keep an eye on, right, that I think are a challenge to Nike's dominance, right? You've got OnCloud, you've got Hoka coming through that are taking increasing amounts of market share. But I mean, globally, we're still looking at a business, Nike, having sort of 16% plus of the global sportswear market, which is an absolutely massive slice of the market share. When you look at it from a valuation perspective relative to peers, they all screen relatively cheaply. So even the likes of Adidas, I mean, we're talking about Nike's turnaround, but Adidas has faced their problems as well. Puma equally so. I think more broadly, you probably would look at the entire sector and go, I think that sort of whole space has been hurt by sort of the economic growth or the lack thereof we're seeing out of China. Or maybe not economic growth, but I think consumption is probably the thing to mention. So that we're seeing some economic growth, but from LVMH to Nike to Adidas, they're all losing sales in China, and it's a big part of sales for all of these companies. So I think from that perspective, they're all sort of battling to a degree, but we think that Nike, relatively speaking, compared to these other businesses, is better positioned, a very strong brand. Not that Adidas is not a strong brand, but we think that they have the right tools and the right team in place that they can actually sort of manage these pressures, because if it's not tariffs today, it's going to be something else tomorrow. There's never sort of perfect conditions for these businesses to operate.
All right, let's get into your last stock pick, that being Amgen, and they operate in that pharmaceutical biotechnology space as well. Something I found interesting is that they're also trying to get into that weight loss market. Just talk to me about your analysis on that counter and why it's your pick today.
So I think, again, we talk about sort of from a valuation only perspective, which I think must be mentioned is sort of the end sort of part of our process. We start on the other end, and then sort of valuation becomes a consideration around, well, when do you enter or exit a position? Having said that, Amgen on a forward PE basis is also trading relatively cheaply compared to sort of the S&P 500, obviously dependent on what your expectations are of earnings growth going forward. But a stock that we like, it's not necessarily the most exciting. It's not like an Eli Lilly sort of on the forefront of the obesity. You mentioned the obesity sort of treatments. And they do have some sort of developments in that space. But I think that it's sort of a case in point of a company that just continues to execute well on what they are good at, right? This stock has been around since the 1980s, so this is not like a new and exciting...
an oldie but a goodie.
Yeah, an oldie but a goodie. We're seeing, they're consistently spending on R&D, which a company that's in biotech needs to spend a significant amount on. And we're seeing their existing pipeline of products and drugs doing well for them. So sort of the obesity side of things is sort of a nice to have, but a company that I think is playing in the right space. I mean, taking a very zoomed out picture, whether it's healthcare or pharmaceutical type stocks, we like the theme around that more broadly going forward. We're not talking sort of a trend over a year or two, but sort of 5 to 10 year trends in terms of, we talk, and I think we've talked about it before, sort of age profiles across the globe, right? We know that Japan's a good example, right? The workforce globally, people are tending to have less children. Africa is a bit of an exception to that, but the rest of the world, largely, people are having less children, and you're seeing that age profile rise over time.
Yeah.
And we think that is a space that the healthcare and pharmaceutical stocks will tend to benefit from on the margins in the long term. And the other aspect to it is sort of it's less of a quantifiable point, but with the prevalence of AI, and we've talked lots about AI, but in the pharmaceutical space and in the drug research space, there's huge potential. And can these companies leverage those systems to actually really accelerate the development of new drugs to treat whatever diseases, and some of these are quite serious illnesses that they specialize in, being cancers, sort of kidney diseases. So yeah, we think that that's sort of an additional potential tailwind for this business in the long term.
Jordan, let's leave it there. Thanks so much for your time and taking us through your analysis of those three counters. That was Jordan Toy from Legacy Family Wealth.